I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on taxing tax-exempt entities.
In March 2026, Scott Hodge, Tax and Fiscal Policy Fellow at Arnold Ventures and President Emeritus of the Tax Foundation, wrote an opinion piece in the Washington Post with a tax proposal that could raise an estimated $51 billion each year. The proposal is to tax tax-exempt entities. In today's episode, we discuss the potential criticisms of the current rules for tax-exempt entities and invite Scott on as a guest to discuss his proposal. Hello, Lisa.
Hello, B.
Well, we have officially or almost officially made it to tax day. I don't even know what day it is, but I know it's April. It's mid-April, so I'll just go ahead and say happy tax day to all of those who celebrate.
I'm celebrating.
That's not a surprise. You are a tax nerd. You are an individual tax nerd.
I am.
Who, I'll never understand it, but actually enjoys doing your taxes yourself. I'm assuming that continued this year.
It did. Yes, that's one reason I'm celebrating. I got back from my student study trip just in time to queue up March Madness while doing my tax return, which is my annual tradition, and I'm not going to apologize for it. I love it.
Wave your nerd flag.
Raising it proud. Yep.
Yes, do it. Do it.
But yeah, the real reason I'm celebrating is that the craziness of teaching an overload this year and helping, run my school and choose a dean and all of these things that have kept me like insanely busy since the fall. It's starting to wind down and I am seeing a light at the end of the tunnel and I feel like I can breathe again, which is lovely.
I am very happy for you. And I remember when we were together in January, you were hoping that April was going to bring some light. And it seems like that is actually happening.
Yes.
And I am very happy for you. And I am hopeful that I will be able to join you in the light at the end of May.
End of May. Okay.
End of May. Yes. I think I am I'm a good 4 to 6 weeks out from no longer feeling like I am drowning in the quicksand of my life.
Okay. Well, I wish you a speedy and relatively painless 4 to 6 weeks. I look forward to seeing you exiting that tunnel.
I look forward to it as well. But on to the present.
Yes.
Today's topic is just rolls right off the tongue.
Yeah.
We're gonna talk about taxing tax-exempt entities.
Yes.
So any of our listeners who want to know more about these tax-exempt entities, these 501c3PO and 501c4 organizations, yes. We have episodes on each of those. We also have episodes on charitable giving, scandals over the IRS granting tax-exempt status to these organizations, because it turns out not just any old organization can be tax-exempt. The IRS has to give you permission. So we've talked about this topic quite a bit.
We have, yeah.
And today we're going to tackle it from another angle, which is to ask whether these entities should really even be tax exempt at all.
So I think the appropriate place to start would be, what does it even mean to be tax exempt? Let's do a quick recap for those who don't want to go back and listen to those episodes.
Fair enough. And this is what I like, because if you take a minute and think about it, you can kind of get there on your own. It means exempt from tax.
Beautiful. Love it.
End of story.
Okay.
A tax-exempt entity is simply an organization. So it's not a person, it's an organization that the IRS has decided does not have to pay federal income tax. And again, you have to apply for this status with the IRS. And in theory, if everything's going properly, they're going to grant it to an organization only if it's doing something beneficial for society, furthering some philanthropic, scientific cause. And the most traditional organization that we would think about that falls into this space would be a charity, United Way, Boys and Girls Club, World Wildlife Fund, things of that nature.
Yeah, food banks, churches, universities, nonprofits helping people in need. If you're serving the public, we'll give you a tax break so you can focus on that mission and put more resources towards that mission as opposed to towards the federal government.
Absolutely right. It's sort of a trade or a quid pro quo. The quid is you're going to do something to help our citizens. The quo is we're not going to take your money that you could otherwise use for that purpose because we're going to make you pay it in tax. Because again, if you think about the purpose of the government is also supposed to serve the citizenry. So it would be kind of silly to take tax from a charity, give it to the government, and then just have the government redistribute it back out to that same population. So we're going to sort of cut out the middleman and just let the charity keep their money to serve the people.
Yeah. And so just to clarify, a tax-exempt nonprofit doesn't mean they pay no taxes ever. It just means they're generally exempt from the income tax on activities related to their mission. And we can go into some of that complexity later. But so far that, on the surface, it should be pretty easy. If it's related to the mission, it's not taxable. And the organization gets to use those funds towards their social mission.
Absolutely. And the problem comes in, because there's always a problem.
Always.
The problem starts to creep in when you realize that some tax-exempt organizations actually just look almost identical to a regular business, to a regular for-profit organization. Over time, some nonprofits, particularly in some sectors, have grown huge, and they generate massive revenue, again, sometimes from activities that look very commercial, but to your point, commercial and related to their mission, right? So you've kind of got an extra layer of complexity here. Clearly, if you're earning money and it's unrelated to your mission, we're going to tax that. But what if you're earning a lot of money so much that you look like a regular business, but all of that income is actually related to your mission?
So how much money are we talking here? Like, is this just like they're earning a little bit, or this is like, no, they're on par with these commercial businesses?
Well, our guest today cites some evidence that nonprofits generated around 2.8 trillion with a T in commercial revenue alone in 2023. So I'm not always great at numbers once they get over a certain amount, but I'm going to call 2.8 trillion with a capital T a lot.
Yeah, this is not local bake sales and lemonade stands.
No, at least not at my child's school.
Yeah.
No.
Okay. Yeah. All right. So let's talk about some examples of nonprofits that might be blurring these lines between a charitable social enterprise and a profitable commercial enterprise.
So the one that I was most familiar with, and maybe that's the same is true for our listeners, is nonprofit hospitals.
Yeah.
So they do great work, obviously. They're serving the community, but they also generate huge revenues, over $1 trillion collectively. This is just among nonprofit hospitals.
Okay.
And they often have a business, I just said it, business model that's very similar to that of for-profit hospitals. They're providing the same services. They're billing patients in the same way. Really, sometimes when you get down to it, the only difference between a nonprofit hospital and a for-profit hospital is one's paying tax and one is not. And again, that nonprofit hospital is being allowed to be tax exempt because they're supposedly providing community benefits like charity care to those who are unable to afford it. And this was when I lived in Athens, there were two hospitals. One was a profit hospital and one was a nonprofit hospital. And if you didn't have insurance, you knew that you always went to the nonprofit hospital.
Yes, but you use the word supposedly there. They're supposedly providing these benefits to, care for those who are unable to afford it. So I'm assuming that there's some question over how much of that care these nonprofit hospitals are actually providing to the community. And that I feel like that should be pretty easy to quantify. Right? A hospital's accounting system should be able to indicate what services are provided that they're billing for versus that they are unable to bill for, and what costs are associated with those services if they have a good cost accounting system. But, I'm just an accountant and not even a very good one at that. So what do I know?
No, I think it's a totally fair point, especially today with computer systems and things of that nature. I think any hospital should be able to quantify who they're serving, and that should be the case for a nonprofit hospital. They should be able to quantify what percentage of their services is going to people who aren't able to afford it. But the bigger question, I think, is that, yes, again, going back to Athens, there was the hospital that was the nonprofit hospital that served people without insurance, but that is also where I had my child, and so they were serving me too.
Right.
So then the question becomes, how much charitable care, how much service provided to those who are otherwise unable to afford it is quote unquote enough to capture all of that hospital's revenue and call it tax exempt? Because right now, even if they're helping one patient who's in need, and that qualifies them as a nonprofit, all of the income that they're making related to their mission as a hospital is exempt from tax.
And I think this is an issue that's going to come up later in our discussion, is like how much is enough, right?
Correct.
Yeah. Another example is the AARP. It's an advocacy group for older Americans, and they earn billions of dollars in royalties by licensing their name to for-profit companies like insurance providers. Okay, that's a little interesting to me. What's even more surprising, I guess, is that they signed a deal last year with the Washington Nationals to place their logo on uniforms. Like
this really is your favorite time of year. We've got taxes, we've got March Madness, and now you've somehow managed to drag baseball into the equation.
Baseball season has started. It's another reason I'm celebrating April. It is truly the most magical time of year.
Okay. We have very different ideas of magical. The PGA Tour also qualifies as a nonprofit, quote, business league. And because you got to talk about the MLB, I'm going to talk about the NFL.
I expect nothing less.
Thank you. It's quid pro quo here, tit for tat.
No comment.
NFL was no comment. The NFL was tax exempt until 2015. And then they actually voluntarily relinquished their tax-exempt status after some intense public and congressional scrutiny. And I think that this is another episode that we're going to have to do eventually.
I think so, too.
It's very interesting why they chose to give that up. But anyway, point being, it's not just hospitals here.
Well, give us like the 30-second version of what happened with the NFL.
I'm going to give you a 30-minute version at some point in the future.
Okay. All right. Fair enough.
Out of curiosity, because we're talking about NFL, talking about my favorite things, thinking about the Oscars, because the Oscars is also a March, April activity that we both love. We used to host an annual Oscars watch party in the PhD program. Have you maintained that tradition?
No, I have not. Well, so this year I was in Europe with my students and missed it completely. Didn't even know it was happening. And plus the time change, there was no way I was going to be able to watch it. But also it's gotten so long as a show.
Oh, yeah.
And at 9:00 at night, I want to be in my PJs, not handing out fancy appetizers to my friends all dressed up. So sorry. The party has gone away in favor of Mama's bedtime.
Understood. And also, I believe that YouTube and the internet has gotten so good at capturing the speeches and capturing the moments that you can just kind of watch what you want to watch
100%
the next day.
Yes.
So shout out Michael B. Jordan, won Best Actor. Love him. I don't know I think it was his first role ever was Wallace on The Wire. So have a special spot in my heart for Michael B. Jordan. Mm-hmm. But speaking of the Oscars, guess what?
I have a feeling there's something about taxes here.
I was going to say, this is where you say what? And I say, the Academy. Let's do that again. Speaking of the Oscars, guess what?
What, B?
The Academy of Motion Picture Arts and Sciences, also a nonprofit organization.
Interesting.
Same with the Grammys and the Emmys. And these are entities that generate millions of dollars every year from very long broadcasts.
Yes.
Sponsorships and ticket sales.
So when someone says, I'd like to thank the Academy, they should also thank the tax code.
Well, absolutely. I mean, you should just do that anyway.
Always. Yes.
Always.
Okay. So we've given some examples here. Why should we care? Why should we care about the Oscars not paying taxes and PGA not paying taxes? Yeah,
I think it comes down to, well, let's be clear. Why do we care versus why does the average person care?
I think this goes both ways.
I do. I think everybody should care. But I think the reasons might be different. I care just because I think it's nerdy and cool.
Yeah.
I think the average person should care because it really comes down to issues of fairness and competition.
Yeah.
And what I mean by that is if we have two entities, a nonprofit and a for-profit, and they're basically doing the same thing, but only one of them is paying taxes, then you can see that that is not necessarily fair, and it's creating an uneven playing field. It's basically the government subsidizing the performance of one entity and not the other.
Yeah.
And so critics argue that some organizations are getting tax breaks maybe when they shouldn't because their activities feel a lot more commercial than they do charitable.
Yeah. So where do we draw that line between, charitable activities and commercial activities?
I think that's the big question. At what point does a, quote, charitable organization become just a business wearing nonprofit clothing?
Sounds like a question we should ask our guest.
I think we absolutely should do that.
Today we welcome Scott Hodge. Scott is President Emeritus of the Tax Foundation, which he led as president for over 2 decades. He's recognized as one of Washington's leading experts on tax policy, the federal budget, and government spending. He's written and edited 3 books on the federal budget and streamlining the government, and has authored hundreds of studies on tax policy and government spending, as well as authored dozens of editorials and opinion pieces. He's here today to talk to us about a recent opinion piece in the Washington Post proposing that we raise revenues by taxing tax-exempt entities. Scott, welcome back to the podcast.
Oh, great to be with you. Thank you very much.
Let's start by going into kind of the origin story of this. What led you to propose taxing tax-exempt entities? What is the problem that you see that fixing?
Well, it's interesting. I've been following, for the last 15 years, the growth of the nonprofit sector. And what's been interesting about it is that, number one, the nonprofit sector generally now comprises about 13% of GDP, which would surprise a lot of people.
Mm-hmm.
But what's most interesting about that is the growth of business income within that, so that now about 75 to 80% of all nonprofit income is effectively business income, generated by everything from for hospitals, it would be insurance payments or payments from patients or Medicaid, Medicare. For credit unions, of course, they earn lots of money on interest and credit cards and things like that. Universities earn a lot through not only tuition, but patents, trademarks,
right.
all these other things. The NCAA gets $1 billion a year in TV revenues, doesn't pay tax. You have award shows and the Pro Golfers Association. You have all of these entities that are very large, very commercially oriented, and they're tax exempt. And this is not only with 501c3 organizations, which is the dominant part of that, but you have then other things like credit unions and all kinds of industry groups and what have you that are 501c4 and other types of nonprofit entities.
Yeah.
And so we've seen this dramatic growth in the amount of business income that is really dominating the nonprofit space. And very little of that is actually taxed under what is known as the unrelated business income tax, which was created in 1950 to tax the, quote, unrelated income for nonprofits. And out of the 2.8 trillion in business income earned by nonprofits, a very small portion of that is actually captured by UBIT. And UBIT raises about $700 million a year out of $2.8 trillion worth of business income. So you can see there's a lot of holes in UBIT, and it's really more symbolic at this point than it is functional or any sort of a way of trying to control the amount of business income within the nonprofit space. So it's been a basic failure. And I think something needs to be done about that. And we need to patch those holes and tax that income. One of the problems that I think is most evident here is that you have nonprofit businesses competing directly with for-profit businesses.
Right.
Whether it's hospitals, more than half of all hospitals are nonprofit, and they're competing directly with for-profit hospitals. Credit unions are competing with community banks. In fact, credit unions are now buying community banks. There's just something wrong with that. And it's kind of like, imagine your YMCA buying Gold's Gym. And I think if you're going to have a free enterprise system, you can't have large industries going untaxed and competing directly with taxed entities, for-profit entities. And so I think we need to level the playing field. One of the most basic principles of good tax policy is neutrality.
Neutrality, yep.
And we don't have a neutral system. Over the last 120 years or so, we have allowed the nonprofit sector to grow into all of these business entities that compete unfairly with for-profit firms. And I think that needs to be fixed. before it gets too bad.
So when you started talking, I did have an unpleasant flashback to the concept of UBTI, which I dealt with very little bit in practice with a few of my clients that were tax exempt. Can you just talk very briefly for our listeners, because it is sort of a very niche concept, what that UBTI is intended to capture? Like you said, the U stands for unrelated, which I think is the important part here, right? That it's taxable income from unrelated activities. What is the fundamental problem with UBTI that it's capturing such a small portion of that $2.8 trillion?
Let's start with the origins of UBIT or UBTI. And it really became an issue in the late 1940s when you had a lot of universities and nonprofits essentially acquiring for-profit firms. And one of the most egregious of that, or at least noteworthy at the time, was New York University, which had acquired a pasta-making company called Mueller Pasta. And it was those kind of entities. And we saw also other things where entrepreneurs and rich people were essentially working out these deals with nonprofits to essentially have the nonprofit buy their business, and then they would have these various leaseback schemes in order to shelter income. And it was getting to be such a problem and so obvious to everybody that Congress decided it had to do something. And so it's really fascinating to read the congressional record as they were debating this issue and realizing how many of these businesses were getting away with not paying tax. And at the time, the nonprofit rules allowed that kind of behavior. They had what they called the destination of income theory, which drove nonprofit businesses, so that the rules allowed any sort of income to go to nonprofits tax-free, as long as the goal was charitable. So that New York University could own this pasta company and get that tax-free profits to support the thing, as long as it was a charitable goal. And Congress said, well, forget about that. That is just wrong. So we're going to create this unrelated business income tax to capture those kind of businesses. They did, however, say, well, if the activity is related to the charitable mission of the organization, we're going to allow it. So that the NCAA can get $1 billion a year in TV revenues because it's going toward the educational activities of the organization. And this relatedness concept has been so abused and is so watered down that it allows, like AARP to get $1 billion a year in royalty income from selling its name to insurance companies because it's related to its goal of advancing care for seniors or some nonsense. So the unrelated aspect of this captures things like rents, some royalties, and some, truly unrelated. Now, if New York University would be taxed now on Mueller Pasta Company because that was clearly unrelated. And what you saw was a lot of these organizations after 1950 shedding those things. So they sold their orange grows, they sold their hat making companies. You would be amazed at the kind of things that universities owned back then and used as income for the university.
So it seems like in that discussion, and thank you for that, you've highlighted sort of the tension here of drawing the line between something that is more related to a charitable purpose and something that is being earned by a charitable entity versus something that is still nonprofit but feels more like a commercial entity. So in your mind, how would you go about that difficult task of drawing the line between a charitable entity and a commercial entity within the tax-exempt space or the nonprofit space?
I think it's truly important that we do draw that line now because it has become so blurred. And I've been greatly influenced by the work of two professors, John Colombo and Mark Hall. Both, I think, are now emeritus at their respective universities. But they developed back in the 90s what they called the donative theory of nonprofits. And in their mind, the charitable nature of a organization should be determined by the amount of donated income that they receive.
Okay.
And they had a really nice way of framing this. They called it a market in altruism, so that the market was stepping forward to send a signal to the tax collectors that this organization, due to the amount of nonprofit donated income it was getting, was truly should be considered charitable. And I've been very influenced by that. And they did make some distinctions and said, well, it shouldn't be just any amount of donated income. It should be at least 30% or 1/3 of their income should come from donations. And that should send the strongest signal that that organization has the backing of the marketplace in altruism and be considered worthy of receiving a taxpayer subsidy through the tax code.
I like that objective, bright line.
Yeah, and there's another way of doing it as well that was developed by James Bennett and Gabriel Rudney, and this is also back in the late 1980s and early 1990s. And they developed what they called a commerciality test. And you got to remember, all of these academics were coming to the same problem and said, the relatedness test is broken. It doesn't work to truly distinguish between charitable activity and commercial activity. So what Bennett and Rudney was doing was trying to develop this commerciality test. It was a 10-part test trying to get at the real market activity, whether there was a commercial relationship or exchange going on between this entity and a customer base. You know, the price of the goods were set by the market. You know, customers had a choice in their decision making, et cetera. So they set this 10-part test to determine whether something was commercial in nature. I'm pretty intrigued by that, but I found their 10-part test a little cumbersome and still subject to, I think, maybe some ambiguity. But what I propose is kind of bringing these two concepts together and effectively trying to determine when is something charitable or organization charitable and when is it truly commercial.
Talk to us a little bit more about your proposal. You proposed two different potential solutions to this problem. What are those solutions?
Well, based on the donative theory, I think you could essentially say we're going to wall off charitable donations or government grants as well, and say those are excluded from the tax base, and we're going to assume that all of your other income as an organization is commercial in nature, whether it's coming from ticket sales or insurance payments or royalties or investment income, et cetera, that we are going to consider to be commercial in nature, and we're going to tax that. And I think that's a pretty good way of doing it because the 990 already requires organizations to segment their income streams in a way that allows you to get at that. I mean, the other way you could do it is try to do this commerciality test that in Rundy, but that doesn't work right now so cleanly with the 990, which already gives us this separation of income. And it wouldn't take a whole lot to sort of manage the 990 in such a way as to wall off these donated income and separate that from the commercial.
Now, correct me if I'm wrong, but the unrelated business income tax rate usually mirrors the corporate tax rate. So that would be 21% right now. Are you in favor of imposing that corporate tax rate on this programmatic income, or would you choose a different tax rate in your perfect solution?
I think you have to have neutrality across all commercial income, no matter how it's earned. So yes, I would tax it at the 21% rate. And if you did that, you could raise about $51 billion a year in new tax revenues just simply by expanding the tax base, broadening the corporate income tax base to include all of this commercial income that's earned by nonprofits.
Going back to your proposal, do you think it's politically feasible?
It's really politically challenging to take on the nonprofit sector.
Yeah.
And I've been beaten around the head and shoulders many times by taking on the credit unions, the hospitals, and so forth. Yeah, they're very politically powerful because every member of Congress has a university in their district. They have a hospital. They have a credit union. They have some other sort of nonprofit. And so who wants to take that on? Plus, most members of Congress are quite feel loyal to their university. It's like, wait, I don't want to tax my university. And my gosh, they're in the Final Four. What am I going to do? So and I just donated to their NIL program and so forth. So yeah, it's really hard. Sadly, we have seen a lot of hearings over the years about nonprofit hospitals or credit unions or what have you. A lot of activity, but little has come from it. So it's a big political challenge. I'll be honest with you. But I've tilted at windmills before.
The other thing you have to think about, as Lisa asked, how politically feasible is it to pass? And then what's it going to look like from an administration and an enforcement perspective? And obviously, as soon as you start subjecting a class of income to tax that was not traditionally subjected to tax, you're going to, in theory, have to fund the IRS a little bit more to give them the ability to make sure that the income is being calculated properly and the tax is being collected. So that would be, I think, another related challenge to doing something like this.
I understand that, Bridget. But I'll be honest with you. I think actually this change could make life easier on the IRS. So the IRS, if you went to a donative theory of determining what's a charity, as opposed to this relatedness test, which requires all kinds of subjectivity. And there's been a lot of lawsuits and tax challenges on this. And the courts have been on both sides of this thing. That's what you want to avoid. And if you went to this pure donative theory and said, okay, if you get more than 30% of your income from donations, we're going to consider you a charity, and then we're going to tax the rest as commercial income. That's a pretty bright line that the IRS, the entities, and the courts can all understand in equal way. So you don't have the amount of uncertainty that you have with this relatedness test or with UBIT, like, well, is this unrelated or related and whatnot.
You just have to hope everybody's properly classifying their donations as donations.
Right.
Yeah, sure. But even now, I think there's a lot of organizations that are engaged in business activity. It's not related at all. It's nuts. I mean, here in Washington, D.C., they've just decided they're going to have a Formula One race in the downtown D.C. Well, the organizing committee is a 501c3 nonprofit. Well, how in the world does that make sense? Where charitable, cause is being done by holding a Formula One race in downtown D.C. So it just doesn't make sense. And at least to me, I think when most people think of a charity, they think of an altruistic entity in which you have people trying to do good for the poor, the hungry, the homeless, etc. They don't think of owning pasta companies as being quite charitable, or selling your name to insurance companies under the guise of a charity.
Yeah.
That's just me.
Well, this has been a really interesting conversation. You've given us a lot of food for thought. Is there anything else you want our listeners to know?
Yeah, within the next week or so, me and my colleagues, Roger Miner and Andrew Morris, have an article that's coming out in the Tax Lawyer Journal, which is the professional law journal. So take a look. It's called Ring Fencing Bad Tax Policy. And it gets into a lot of this, and especially spend a lot of time looking at the history of UBIT, the nonprofit sector, and how all that developed. And so you can see a little bit more of the details that I outlined in the Washington Post piece. So take a look at that.
Very cool. Yeah, we'll keep an eye out for it.
Thank you. Appreciate it very much. And happy to join you at any time. So you guys are terrific. It's a great program.
Well, we love having you on. Time for the good, the bad, and the ugly. And I'll start with the good. Honestly, this issue hadn't really been on my radar. So, major props to Scott for bringing this to our attention and the problems associated with this very sizable commercial looking industry being treated very differently by the tax code.
I agree. The numbers that he put forth in the Washington Post opinion and also on the pod today, the $2.8 trillion, that's staggering, and that's much larger than I ever would have guessed that it was.
Yeah, agreed.
I'll also say another good, and correct me if I'm wrong, I think we just had our first repeat guest.
Yeah, we did. Yeah, and he was great. He's been great both times. Really enjoyed having Scott on.
We've got a regular. I like it.
I think the big bad here that I'm really struggling with is where, I still don't know exactly where to draw the line. I mean, Scott, gave a very reasonable proposal of if a third of your income is coming from donations, then you're a charity. But that's like I like that it's a bright line test. It's very black and white, but it's also an all or nothing, right? You trip that 1/3 threshold and suddenly you're tax exempt on that income versus you fall just a little bit short because maybe your commercial stuff did a little bit better than you thought this year and people aren't as giving this year. And all of a sudden you're not, is that fair to have? And it makes me think it needs to be a 3-year average or something to get rid of the vagaries of just the economy is different this year and suddenly your commercial enterprise is doing great, but nobody's giving you the donations that they promised.
So I appreciated how he presented sort of two ways to go about it. One is exactly what you said. It's a bright line rule, that 30%. We love bright line rules because they're clear and they're easy to understand.
Yeah.
Challenges you just mentioned. Another challenge is they're really easy to avoid. So let's say you are sitting at the end of the year and it looks like you're only going to hit 29%. Can you start calling on your board of directors or your executives to kick in a little bit of an extra donation to get you over that 30% threshold? So bright lines have strengths. They also have weaknesses.
Yeah.
On the other side, he talked about that 10-part commerciality test, which I think is trying to take a more theoretical approach, but 10 parts, get out of here. Everybody's asleep after part 3.
Yeah.
And that's just going to cause a bunch of confusion. So I really liked how he put forth these two different theoretical ways of looking at it, and they each have pros and cons. It's not easy.
Right. Yeah. And what's even harder is, and I'm going to say we're delving into ugly territory here, is even if we had bipartisan support for this, even if everybody said this is ridiculous that these organizations are earning this much commercial income and not getting taxed on it, it's going to be really hard to pass politically.
Really hard to pass. And I do think I'm going to stick to my guns and say I think it would be tricky to administer. And I
agree.
Don't know that $51 billion of extra tax revenue would automatically materialize because whenever someone's paying tax, our expense is going to go up all of a sudden. Are we going to start doing the things that we see for-profit entities do to try to lower their tax burden?
For sure.
I see Scott's argument that it's easier than the UBTI that we have right now, the unrelated business taxable income, if you just go with a bright line cutoff. But anytime that you start making someone pay tax, the game playing and the avoidance is going to kick into high gear. And if you really want to get all that $51 billion and preserve it, I do think that the IRS would have to get in there and do a little bit more work than they're currently doing.
Yeah, I agree.
So good idea. I'll give it A for concept.
Yeah.
I think I'm less optimistic about the political and the administrative feasibility.
And I mean, that's Basically, a very common story that we keep coming back to, right?
Sadly, yes.
Yeah. But it's April.
Congratulations.
I'll see you at the finish line in another month.
Thank you. Thank you.
Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.